Good afternoon, everybody. We're so thankful you're able to join us today for this commercial webinar as part of our commercial webinar series that we're doing for this year. We have the privilege of having Mishika Gilroy here today. She is the chair of our commercial committee, and she is going to give a brief introduction of what this webinar is about and also introduce our speaker today. So with that, Mishika, can I go ahead and turn it over to you?
Yes, you can. And I don't think people can see me, but hey, I'm still here. Welcome, everybody. We're really glad that you have joined us this morning. And I get the pleasure of introducing Mr. Chris Peterson, our speaker for today. So let me give you a little information about him, and then let me sit back and give him the floor. So Mr. Peterson, there we go. Mr. Peterson is the founder and president of Brazos 1031 Exchange Company. He graduated from Wheaton College and the University of Texas School of Law. Besides his position with Brazos 1031 Exchange Company, he is the owner of Peterson Law Group, an estate planning, elder law, probate, and business planning law firm right here in Texas. In addition to practicing law and conducting 1031 exchanges, Chris is active in lots of things. He currently serves as an elder at Westminster Presbyterian Church. He previously served as president of the Bryan School Board, president of the Bryan Business Council, chairman of the board of the Research Valley Partnership, moderator of South Texas Presbytery, vice president of the Brazos County Economic Development Foundation. And there's so much more. Chairman of the Texas Triangle Regional Center for Innovation and Commercialization. The list goes on. In addition to all of this, Chris is a serial entrepreneur and has been involved in starting businesses ranging from a local community news magazine, chocolates, and real estate development. He's been married to his college sweetheart, Debbie, since 1996, and together they have 3 kids, one of whom is adopted. And with all that said, Mr. Peterson, thank you so much for joining us. We can't wait to hear your presentation today.
Thank you so much. John, could you go ahead and start the video for me?
I think we're getting started on that in just a second there.
Okay.
There we go.
Chris and Mishika, I greatly apologize. I am trying to figure out how to get your video started. I don't think I have the ability to start it. Do you not have the ability to click on start video on your side?
Yeah, it says you can't start the video because the host has stopped it.
Okay.
They blocked us.
Well, apparently I have more power than I thought. And so if you can bear with me for a quick moment, I will continue to work on that.
Okay.
If you go ahead and start, I'll let you know when your video is ready.
Okay. Let me see if I can still share my screen. Is
Yes.
the screen coming up?
It is.
Well, that's good because my face isn't that pretty, so you guys really don't need to see me anyway. I'm glad to be with y'all today. Thank you for the opportunity. We are going to be kind of walking through 1031 exchange basics, and I will tell you that normally when I do a presentation, what I want to leave you with is what are the questions that your customers and your clients are likely to ask so that you have the answers that you need to kind of fill in the blanks for them and then push them through to their exchange agent or whoever they're using to help them with their 1031 exchange. I'm going to kind of skip over this just about me, but let's talk about what a typical transaction looks like. So anytime that we're doing a 1031 exchange, right, what we're talking about is how are we going to kick that capital gains tax can down the road, right? So kind of the rules of taxation, the number one option is to not pay it. And the second option is to defer it. And then a distant third is to pay it immediately. And so in a typical real estate transaction, let's say that we have John who buys the property for $100,000. And then he sometime later decides to sell it for $150,000. And so we would consider that he made $50,000. And of course, if he doesn't do a 1031 exchange, he's just going to pay capital gains taxes on that $50,000, right? So, and at current rates, he's probably looking at a tax bill of about $7,500 on that $50,000 worth of gain. Well, what we're doing in a 1031 exchange is we're going to take the money that he makes from selling this property, and instead we're going to roll that into a replacement, and we're going to defer those taxes for some time later. And so here we have Jane. Jane also is a real estate investor. She has bought a property for $100,000. She sells it for $150,000. And so she is going to make the same $50,000. But instead of just paying that capital gains tax, Jane does a 1031 exchange. Jane's taxes are going to be deferred until some later point in time. Okay. And the benefit of doing this for Jane is, instead of paying that $7,500 that John paid to Uncle Sam, Jane is going to have that $7,500 as additional equity in this new replacement property. So that just kind of illustrates a real simple example of the difference between paying it now and deferring it for some time later. So what are the typical steps that your clients are going to run through as on a 1031 exchange? Well, the first thing obviously is they're going to enter into a sales contract. We always advise that as part of that sales contract that they would include a cooperation clause, and we'll talk about what that looks like. But basically just something where it says that the other party is going to sign documents to help with the exchange. And then they are going to retain their qualified intermediary. Here I used us as the example. And then what's going to happen is there's going to be kind of a couple of roles that the qualified intermediary is going to play. The first is that we're going to do the paperwork to make sure that the transaction qualifies for 1031 exchange treatment under the tax code, right? And then the second is we're going to be the holder of money between closings. So that's really the two roles that the QI is gonna perform. And so before closing on the sale of the relinquished property, so the property that your client is selling, there's going to be certain documents that the QI is going to have that are going to need to be signed before or at that closing table. Okay. And then instead of your clients getting the money at closing, instead those monies will be wired from the title company or the closing attorney to their trust account with their QI. Okay. So clients never get their hands on the money. And that's very important. Then the next thing that's going to happen is from the date of closing, you're going to have 45 days to identify replacement properties. And we're going to talk about the identification rules and what that looks like. It's not nearly as complicated as what it sounds. And then inclusive of that 45-day period, you're going to have 180 days to actually close. So those are kind of the two deadlines that you're going to keep in mind and that clients will ask you about all of the time. And then what's going to happen at the second closing, when you're actually purchasing the replacement property, that property is going to be deeded directly to the owner. So it's going to go directly to your client, and the QI will have delivered the money to the title company or closing attorney to complete the transaction. And then once that property is deeded, then the exchange is complete. And then the next thing that they're going to do is the owner is then going to report the transaction on their tax return. And this is really important because it's going to relate back to whenever the first transaction closed. So like if you sold a property in December of 2022, and then you didn't purchase the replacement property until April of 2023, you're going to report it on your 2022 tax return. So it's your earliest transaction is going to determine what tax year the return gets filed for. And the form is pretty simple. It's form number 8824, and basically you're going to just report the kind of the closing costs, the original tax basis of the property, and we can talk about some of that stuff later. But those are in kind of a broad brush, those are the 8 steps that you're going to complete as part of the 1031 exchange. So let's get to some of the questions that people typically have. And these are the questions that we answer every day in our office. So the first is just, who can do it? And there's a very simple answer. It's any taxpayer can do it. So when you think about who files a tax return, that basically is going to inform who can do a 1031 exchange. So that could be an individual or a married couple, as a taxpayer, filling out their 1040. It could be a corporation, an S Corp or a C Corp, a partnership, whether it's a general or limited partnership, LLCs, trusts. Any kind of tax-paying entity is going to be eligible to do a 1031 exchange. And so we do exchanges all the time for different types of entities in addition to individuals. What property works for a 1031 exchange? Well, it's any property that's used for a trade or business or for investment purposes. And really what that means is that category is really, really broad, because it basically just excludes things that are primarily used for personal use. Now, the way the IRS explains personal use is, have you used it for more than 14 calendar days in the last calendar year? So you're looking at, have you used it for more than 14 days? So we find things all the time like Airbnbs that will qualify because the owners don't use them primarily for personal use. They only use it incidentally for less than that 2-week time period. One thing that we get questions on all the time, a lot of people will sell like farm and ranch properties, and they'll have a homestead out there, and you can still do a 1031 exchange. Basically what you do is you cord off the homestead piece from the rest of the land, which typically is under an ag exemption and is used either for farming or hay or cattle or goats or something like that. And so you'll apply the homestead amount for just the homestead and maybe an acre or two, and then the rest of the acreage can still qualify for 1031 exchange treatment. And the key thing with the property is just that you need to reinvest the proceeds in like kind property. And we'll talk about what like kind means. So this is probably the most confusing and misunderstood aspect of 1031 exchanges. This question of what is like kind. The like kind rules are actually way broader than what most people think. And there I am. Okay, so now you can see me and see the slides, I'm presuming. So what constitutes like kind is going to be way broader than what most people think. So like kind, the definition as far as the IRS is concerned is that like kind property is property of the same nature, character, or class. Quality or grade does not matter. And like most definitions that you will see in the tax code, that is a bunch of gobbledygook that nobody really knows what that means. It's not very clear, right? And so the very simple rule is that all real estate will be like kind to all other real estate. Okay, so all real estate is like kind to all other real estate. So in practical terms, what does that mean? It means your client who's selling a single family rental is more than welcome to buy raw land. Your client that's selling raw land can buy 5 duplexes. They can sell 5 duplexes and buy an apartment complex. They can sell an apartment complex and buy industrial properties. They can buy self-storage. They can buy raw land to develop along the coastline. Any kind of real estate is going to be like kind to other real estate. The other thing to keep in mind is that you may run into some forms of real estate that we don't typically think of as being like kind and eligible for 1031 exchange treatment. So for example, if people are selling oil and gas mineral rights, those can qualify for like kind treatment. If somebody is trying to buy easements, like you can use that to do 1031 exchange. So we had a whole bunch of clients whose CenterPoint was trying to build a transmission line through a whole bunch of ranches near here. And we did exchanges for those folks when they sold those easement rights to CenterPoint. So just when you're thinking about what does like kind mean, just think in the broadest terms possible. All real estate is going to be like kind to all other real estate, including some of those forms of real estate that we don't typically think of. What property is not going to work? Well, the things that aren't going to work are things that are not really real estate interest. So they're going to be things like inventory in a business. So you might have a business that's being sold and you might sell the physical property, and they might also sell the FF&E as part of that. Well, the FF&E you can put a value on and just take care of, and then the real property can still be part of a 1031 exchange transaction. We can't sell stocks, bonds, notes, securities, debt. The one that we run into all the time is people wanting to buy out their other partners. There's ways to do that, but you can't acquire partnership or LLC interests or interests in trusts that way. So what are the big time limits that apply? Okay, this is probably the area that you need to keep most on top of with your customers. Because their time limits are strict and they go really short, especially in hot real estate markets. So from the time that you sell your relinquished property, your client is going to have 45 days to identify the replacement property. And then they're going to have 180 days to complete the exchange, which means that they're going to close on all of the replacement properties that they're buying. And those time periods are going to come really quick. Everything starts, day 0 is the date of closing. And the 180 days includes the 45. So they don't stack on top of each other. So it's not 45 plus 180, it's 180. And then in the first 45 is when you're going to identify the property. And the thing is, there's no extensions. So we always have clients that are getting desperate. They're running up against their time frame, and then they call or they'll email and they'll say, "Hey, Chris, will you grant me an extension?" Well, I'm not the grantor of the extensions, right? That's the IRS. It's their rules. This is their show. So I don't have any authority to grant extensions, right? And so there really are no extensions. The only time that extensions are granted is when there's a natural disaster and the IRS declares that disaster they are extending the limits. So a lot of times when there are natural disasters, the IRS still won't extend the limits. But you guys who have been here through Hurricane Harvey, Hurricane Katrina, like I have, those were both times when the IRS declared, "Hey, this is a disaster and we're going to extend the limits for a period of time." In fact, just this week, they extended the limits for some transactions within about 20 counties in California because of natural disasters that have occurred there. So can the time limits be shortened? So we already know they can't be extended without some kind of declared natural disaster by the IRS, but can they be shortened? Yes. and they can be shortened because your client accidentally shortens them. So if you've got a 1031 exchange that takes place during sort of the last quarter of the year, you want to be really careful about this. So the 180-day deadline is actually not 180 days. It's actually the earlier of 180 days or the date that you file your tax return. So let's say that we have somebody who does a 1031 exchange. They sell their relinquished property in December, okay? Well, normally their 180-day deadline is going to be, you know, sometime in June, right? Well, if they file their tax return on April the 15th, then they're actually going to shorten their 1031 period to the date they file that tax return. So instead of getting until June, instead they've got to get their replacement property by April the 15th, or whenever their tax return is due. If it's an entity, maybe March 15th. So if you have those super organized clients, you want to make sure if they're doing a 1031 exchange and they're kind of in that back quarter of the year, that they file an extension, give themselves the full 180 days, and don't, you know, jump the gun and file their extension or file their return early and thereby shorten their time periods. So the time period issue is kind of a tricky wicket with the IRS because, you know, they won't extend it, but they're more than happy to have the period shortened because of filing the tax return early. So the other big question that we get all the time is, how many properties can I identify? And so there's 3 different rules about how many properties that you can identify. The first rule is the 3 property rule, and that's the one that most people do. And so what this says is that you can identify up to 3 properties, and we don't care what the value of those properties are. So let's say you sell a property for $100,000. Under the 3 property rule, you could list 3 industrial properties that were $5 million each, and we don't care what the amount of those values are in relation to what you sold. Okay, so 3 property rule, pick any 3 properties you want, go crazy. Okay, there's also a 200% rule, which means that you can identify more than 3 properties as long as the aggregate value is less than 200% of what you sold. So just to kind of keep it simple, let's say you sold the $100,000 piece of property. And so if you wanted to pick out 10 lots that were $20,000 a piece, just raw undeveloped land, and you decide to buy these 10 infill lots, you could list all 10 of them. You wouldn't even have to buy all 10 of them, but you could list all 10 of them to meet this 200% rule. So these are the 2 most common things that clients will do, is either the 3 property rule or the 200% rule. And then the next one that we have is the 95% rule. So this one becomes a little bit more difficult. So the 95% rule is where we are going to show 95% of the properties that you identify are timely acquired. So you don't have to follow the 3 property rule, and you don't have to follow the 200% rule. So you could have more than 3 properties, and they could exceed that 200% threshold, as long as you acquire 95% of the value of all of them. So the reason that this gets hard is because typically, like, you cannot be off even 0.1% on this. So if you end up buying 94.9% of the properties that you identified under this 95% rule, you will fail the test and your exchange will fail. because you did not meet that 95% threshold. So just kind of keep in mind as you do this, you're going to use the three property rule, the 200% rule, or the 95% rule. Okay, those are your three options. Yes.
Really quickly, I want to ask you, do you want to take your questions towards the end, or did you want to catch them live time since some people are asking about the 200% rule?
Yeah, John said we were going to catch them all at the end. I should have made an announcement about that. So if
Okay,
folks
no
will just
worries.
throw it into the Q&A box, then we will get back to him, and he was going to moderate that, I believe.
Awesome stuff.
So
All right.
that was the plan going on. But I'm happy to talk about this. One thing I do want to tell folks is this issue of property identification. A lot of times, clients are really nervous about that because they're not sure, like, oh, what do I have to do to identify properties? It's actually really simple. So like in our office, we send a form out that can be docu-signed, and you basically you can enter the property address. If you have legal descriptions, you can enter the legal description. You can also identify it by the appraisal district numbers. So you can put like the R number in there from Harris County Appraisal District, just some way that distinctly identifies the property. And so usually all it is we send you this form, you fill out, 3 addresses, you digitally sign it, and you send it back. So that process is not overwhelming, although it does typically make folks nervous. So just kind of be aware when you're working with somebody to calm them down that they're just going to be supplying a list, and it's going to be signed and dated. And it is due by midnight of that 45th day. And if you want to amend your list as you go on, you can do that. So typically the QIs will let you amend your list. You just can't do an amendment after that 45th day. So midnight, 45th day, that's what locks you in. Who can be my exchange agent? What you need is an independent qualified intermediary, which means that if it's somebody that's involved in the transaction, they are not considered independent. So like you don't want to use like yourself as the broker, being both the broker and the QI. You don't want to use the client's attorney to do it. You don't want to use the client's CPA to do it. You want to use an independent qualified intermediary. Now, kind of the dirty little secret of 1031 exchange business is that not every state regulates QIs. And so you want to see who meets the requirements of the states that you're buying property in order to make sure that they're eligible. So I've run into that quite a few times where we've had to take over files because folks were not eligible in the state of acquisition. Clients are always asked, do they need to reinvest everything? So if you're closing on something, whatever your net sales proceeds are, in order for you to get a full deferral of your capital gains taxes, you're going to need to reinvest everything. Okay. So all of the net sales proceeds from transaction 1 is going to be pushed towards the replacement property or properties. Any amount that you take out will have a tax impact. Now, with that being said, we have clients that do take money out, and what they'll do is they'll get a partial deferral. Money that is received outside of the exchange is called taxable boot. So that's where that term will come in, and you get taxed on that boot. So we have clients all the time that will say, hey, I want to pay off other debt, or my kid's going to college and I want to just go ahead and pay their tuition for the year, and they'll pull $50,000, $100,000 out of the exchange up front. And you can do that. They just need to be aware that they're only going to get a partial deferral of the taxes, and they definitely are going to be taxed on the amount that they pull out. I always suggest, if clients are thinking about doing taxable boot, that they get with their CPA and make sure that they know exactly what the tax amount is going to be because of that. Sometimes they'll have losses that counteract it, so it won't matter. But oftentimes they will have taxes to be paid. So I want them to figure in the amount of those taxes when deciding how much money to keep back. So we want to make sure that they do it. The other thing that you should tell your clients is when they can take that money. And so if they're going to have taxable boot, they need to take it at the first closing so that they have the money right away. Because if they don't take it at the first closing, they can't get it until the exchange is over. So you can't, let's say that we have $1 million transaction, the title company wires us $1 million. Now the $1 million is part of the exchange. We can't then turn around and cut the client a check for 100,000. We have to hold the $1 million until the end of the exchange at that point. So if your clients do want to take taxable boot, make sure that they get it on the front end so that they have the money that they need and understand kind of the timing of when they'll get funds. How much do I need to spend on my replacement property or properties? Well, again, to get a full deferral, what you're going to need to do is reinvest everything from the sale, and you're going to need to buy replacement properties that are equal or greater than what you sold. So, I mean, just to kind of keep it simple, not counting depreciation, other expenses, but if you sell a $100,000 piece of property, you're going to need to buy at least $100,000 worth of real estate. Now, that doesn't have to be in only one property. It can be multiple properties, but you need to buy at least equal or greater in the value of what you sold. And if you do less than that, then you're going to only get a partial deferral, and probably some of that you did not spend, some of the value that you didn't spend is probably going to be counted towards you as taxable boot. So you really want to make sure that clients are just understand that what their market is, that they've got to do something that's equal or greater in value than what they sold. A lot of people don't realize that there are multiple types of exchanges. And you guys are probably have a better understanding of this than most folks I talk to, because most commercial realtors have been involved in all four types. But there are different types: simultaneous, deferred, improvement, and reverse. And what we always tell clients is, hey, look, these are just tools that you have available in the toolbox. And so you don't have to always, use your screwdriver. You can use your hammer if you need it. So just pick the right tool for the transaction that you're doing. The simultaneous exchange, these are where you're going to do two closings on the same day. And basically the money is never really going to leave the title company. So you're going to do two closings, same title company. Sometimes it can be in one closing session, or sometimes it'll be, back to back, depending on how they do it. And basically you're going to sell it and you're going to acquire it on the same day. And the title company typically will just transfer the funds internally from closing on this file number to the closing on the second file number. A deferred exchange is the most typical kind of exchange that everyone does, where you're going to sell property, and then at some point in the next 180 days, you're going to buy the replacement. So this is the one that most people are kind of familiar with, is the deferred exchange. So you're going to sell something and you're going to acquire the replacement property within 180 days. An improvement exchange is where we want to sell something and then we want to acquire something, but then on the replacement property that we've acquired, we want to do something to that property. We want to make capital improvements to it. And so the key thing to remember here is that the role of the QI is going to change. So before we talked about that the QI is going to do the paperwork and be the holder of money. Well, now in an improvement exchange, we're going to add a third role because they are also going to be the temporary title holder on the replacement property. So what's going to happen is we're going to do the paperwork to do the exchange. The title company is going to send us the money. We're going to use some of that money to acquire the replacement property. We're going to temporarily hold the replacement property while improvements are being made. And then your client is going to do whatever construction activities that they're going to do on the property. Basically, they're going to act as project manager. Typically, we will pay draw requests. And so we'll pay a general contractor or maybe subs directly draw requests. And then when either the money has run out, the 180 days has expired, or the project is finished, then we're going to transfer the property to the owner. Okay. So basically just temporarily while the improvements are being made, our third job is to hold the property until the improvements are finished or until the time period runs out. The reverse exchange. So we have a little joke in our office that 2022, kind of like how the Chinese New Year has different, animals that go with it, the year of the dragon, the year of the rat. 2022 for us was the year of the reverse. In really hot real estate markets, what we had a lot of our clients do was they found a great deal and they had to buy it immediately before they had even decided what property that they wanted to sell. And so we did a lot of reverse exchanges. We're still doing a lot of reverse exchanges. But basically what we're going to do is we're going to buy the replacement property first, and then sometime within the 180 days, we're going to sell the relinquished property. And so what this means is that, again, kind of the role of the QI is going to change. We're going to be the paperwork. We're going to be holder of money, and we're also going to be temporary title holder. And so what's going to happen is basically the owner is either going to loan us money, or combination of them and a bank is going to loan us money to acquire the replacement property. Then they're going to sell their relinquished property. The proceeds of the relinquished property are going to then be used to pay back the cost of the acquisition of the replacement property. And typically the way we're going to do it is we're going to pay the owner first, and then any leftovers, we're going to pay down the indebtedness to third-party lenders. And so again, just know that this tool is in the tool bag. So if you run into somebody that finds the deal of a lifetime, they don't have any of their property listed for sale, like go ahead, you can go ahead with the transaction, do it as a reverse exchange. They could even list multiple properties, and just whichever one or ones sell first can go towards the acquisition of the replacement property. So how do we make this happen? How do we get started on this transaction? My advice always is that you want to get the QI, the qualified intermediary, involved as early in the transaction as you can. So we always like being involved in the transaction even before the contract the first contract is signed. But you definitely have to have your QI in place before the first closing. So one of our little axioms in the office is that once you've closed, it's too late. So we get a call every single day from somebody who tells me, hey, we want to do a 1031 exchange. I just closed and I just deposited the check from the title company. And then we have to be the bearer of bad news that, hey, you've already closed, it's too late, there's nothing we can do for you. So you want to make sure no matter what kind of exchange you're doing, reverse exchange, improvement exchange, deferred, simultaneous, before the first closing, you have to have your QI in place and you have to sign the QI documents. You also want to make sure that you include that cooperation clause in the contracts, and you want it in both the contract where you're buying and the contract where you're selling. I've got a couple of examples of cooperation clauses that we send out to folks. These are also on our website, so if you need them, you can either email me. My email address will be on the last slide, or you can go to our website and you'll see them there. But you want in the contract where your client is selling, you want a cooperation clause, and in the contract where they're buying, you want a cooperation clause as well. Now, in Texas, a lot of people are using either the pre-printed TAR forms or the pre-printed TREC forms. The TAR forms, especially the commercial forms, have 1031 language in there. It's a check the box election. And so instead of using our language, you're welcome, just use the TAR, check the box, just make sure you get the box checked. In the TREC contract, we usually just suggest that you cut and paste this in to the special provisions paragraph, which is, I think, 12 now. So do that. If you've got an attorney that you're working with that is helping your clients, usually we just send them an email and they can just cut and paste it into the contract itself. But you do want to make sure a cooperation clause is there so that the other side knows, hey, we're doing a 1031 exchange. You may be asked to sign something. You're agreeing to sign it and cooperate with us in our 1031 exchange, but it's not going to cost you anything. And so it's really helpful to have these cooperation clauses in the contract right from the start. Before we get to question and answers, which we're going to have quite a bit of time for, about 15 minutes, I do want to tell you about a big announcement that we've got. In fact, we just finalized it this morning, so you guys are the first ones to see this. This is the only plug I'm going to give for us, but we actually are changing our name. When we started the company in 2009, we were very regional, and Brazos 1031 Exchange was a great name that most Texans knew. But the more national we have gotten, the bigger drawback that has been. So we are changing our name to Wealth Builder 1031. This is our new identity package that we're doing, and so you will see. Right now, all of our URL addresses and stuff are still the Brazos1031exchange.com, but eventually those will get transitioned over to Wealth Builder 1031. And so you'll see this logo got put up on the website this morning for the very first time. So anyway, that's our big announcement. And with that, let me give you my contact information. Like I said, this is our current contact information. You're welcome to call the office if you ever have any questions. I know that a lot of times when dealing with QIs, folks will say, hey, I called the QI and all they ever tell me is to go talk to my CPA and my attorney, which I get. We tend to answer as many questions as we can up to the point that we just can't answer them anymore. So if you need help, just call. My email address, my personal email address is just Chris, C-H-R-I-S, at Brazos1031exchange.com. So feel free to contact me if we can be of help or if you have questions. And with that, I am going to stop sharing the presentation and I will take whatever questions that you guys want to hit me with here. John, are you going to moderate those or do you want me to?
Yes, I have them. I went ahead and pulled them out and put them in a document. And so I'll go through them really quick. So before I do that, just thank you for that presentation. What a wealth of information. And I know people were very engaged because we have a lot of questions and it is entirely possible that they're very similar in nature. And so I apologize in advance because you guys are the practitioners and I am not. But I will try my best to weed through it and compile the questions as I go along. The very first one and the most prominent one that came out a couple of times was, are you able to share your slideshow presentation with the people that are here today?
Absolutely. I will send the slide deck to you, John, and then you guys can distribute it as you see fit.
Great, Chris, we appreciate that. Thank you.
Mhm.
At which point in the purchase process will the buyer need to inform you about the replacement property, after or before the purchase contract execution?
So they don't have to tell us until that 45-day deadline. So they can go ahead and get their contracts in place and then inform us. And that's totally okay, as long as they let us know by midnight of that 45th day. And just kind of our practice, which I think is similar to a lot of the firms that practice nationally, like we send repeated reminders to clients so that they don't forget, hey, your 45 days is coming up. Like, hey, we really are serious. Like by midnight, you got to get this to us. And the people that are truly last minute start getting anxious phone calls from our staff about, hey, you're making us super nervous because we haven't heard from you, and we really need to get this in place or your exchange is going to go bye-bye.
Awesome. Do you have to disclose 1031 exchange of the sale of the property in the contract?
No, you're not required to disclose it to the other side. The only reason that we suggest, well, let me tell you, there's two things that I suggest. One is to use the cooperation clauses. So when you're dealing with the other side, one of the things that they're going to be asked to do is at the closing table, they're going to be asked to sign a notice that they understand that the contract that they have with you is being assigned to your qualified intermediary for purposes of receiving the funds, okay? Or in the replacement property transaction, for the purpose of the QI sending the money to the title company, okay? So sometimes, I mean, this happens like maybe once or twice a year, where some knuckleheaded seller or buyer who's never done any of this stuff before gets real nervous about being asked to sign things that they don't understand. And so it is very helpful to have that cooperation clause to say, hey, look, as part of our contract, you agreed that you were going to sign the things that helped us with our 1031 exchange so that we could either sell you the property or we could pay you for your property. And so that's why I always suggest that you put the cooperation clause in. The second thing is, I think it does help to have that conversation early in case they have questions about it, because we can calm it down. Because a lot of times we'll even have, we'll have like a realtor call us and say, hey, I'm on the other side of the transaction. I don't know what this is going to mean for our client. And we try to basically just say, hey, look, it's not this big of a deal. They're going to be asked to sign one piece of paper. Like, don't flip out on us. If you are buying property, I actually think it helps you when they know that you're doing a 1031 exchange, because what that generally means is you have the money, right? And so there's not this question of, are they going to be able to get the financing? Are they not going to be able to get the financing? Hey, we already got the cash and it's sitting in a bank account, with our name on it, just waiting for closing. So I've kind of seen it from our perspective a little bit differently, because we see a lot of sellers who like knowing that the 1031 exchange is happening, because they know that lending is typically not an issue for those clients that are trying to buy.
Thanks for that. When you identify a house, is that the one you have to purchase?
Whatever you purchase as replacement property has to be on your 45-day identification letter. So if you identify, we don't suggest that people do this, but let's say you put all your eggs in one basket and you say, okay, I'm buying 123 Main Street, Dallas, Texas. Okay. And then you put that under contract. You don't get around to doing the inspections or environmental until after that 45-day period. And you find out, hey, it's a Superfund site, and we don't want to buy it, Well, you've blown your 45-day deadline. We can't go back and amend that, right? So because you put your eggs all in the 123 Main Street basket, we're stuck with 123 Main Street, or you don't get to do an exchange and you're just going to pay taxes, right? So you always want to, whatever you buy has to be on that 45-day letter, and make sure that you have backups. Make sure you have backups. Help your clients make sure that they have backups. So that if something falls apart and something screwy happens and you happen to find the environmental disaster in the middle of, Pecos, Texas, like that's fine. At least you got something else that you can buy.
Okay. If you sell a $300,000 home, can you buy 2 homes?
Absolutely. You can break it into multiple replacement properties, so you're not limited. Your limitation is on value. So in order to get a full deferral, you've got to buy at least the $300,000 worth of homes in this example. But that could be 2 properties that are $150,000 each if you want to do that. What I would say is really common in the single family rental area in particular is that we'll have a lot of clients that will harvest their gains from one property, and then they will take that money and they'll put down payments on multiple properties. So they kind of increase the whole overall portfolio with lending on top of it. So you could take that $300,000 gain, let's say, and you take that $300,000 by 6 properties, put $50,000 down on each property, have lending over the top of it to pay the rest of the price, and you could increase and diversify your risk in your portfolio. So buying multiple replacement properties is no problem at all.
Got it. With the 200% rule, is it 200% of the value of the property you sold, or 200% of the value of the amount of profit that you're deferring taxes on?
Yeah, so it's a more complicated scenario than that, because there's some other things that go into it. In fact, this gives me a great opportunity to share something with you. I pulled it up just in case something like this came up. We have a little Excel spreadsheet. I know this is probably a little bit hard to see. Let me see if I can increase it a little bit so that folks can see it better. And if you want a copy of this, let me know. So this is how we estimate tax liability. And so it basically, it's just a spreadsheet that you can plug different numbers in. You can get things like, hey, what did it cost me to acquire the relinquished property? How much improvements have I put in? How much depreciation have I taken off of it? And then, hey, look, what is my adjusted tax basis? What's my exchange basis going to be? And then it's going to calculate your tax. And then we have put in the tax tables for 2023 income tax, long-term capital gains tax, and even that net investment income tax into it. So you can basically take the tax rates that are here and plug them into the formula so that you can figure your own rates. So it's a little bit more complicated than that. I always tell clients, though, to make it easy. So if you're selling a $300,000 piece of property, look for something that's $300,000 or more, because you know you're going to be safe in that area. And then my second piece of advice to folks is that this is where I punt to the CPA. So so the CPA, there's a kind of a one-page form that gets included with the tax return. It's Form 8824. It gets included in the tax return to report your 1031 exchange. Just have them do a quick and dirty analysis of it, so that you can see, hey, what's my potential tax impact? What do I need to buy to make the numbers work? And they can do that. The beautiful thing about that is they're going to know other losses that the client has. So just as an example, last year we got a call from a US citizen who lives in Singapore, and they were selling property in Florida. And they called, and it looked like it was going to be this big gain. We were kind of helping them, and I just said, hey, I'd really feel better if you talk to your CPA and just make sure that this is the best thing for you before you do it. And she called me back the next day and said, Hey, I appreciate that. What I didn't realize is we had carry forward losses from other things, and it completely subsumed our capital gains tax that we were going to have to pay. And so it netted it out, and we've been carrying forward these losses for a couple of years, and we've never been able to use them. And so instead of doing an exchange, I mean, I was a little sad because it was about $1.5 million exchange from our side. So I was sad to lose the business, but I was happy for her because she was able to basically not do the exchange, just do it all in cash and recoup those losses that she had had in previous tax years. So that's what I always suggest that clients do. But as a quick and dirty analysis, I would look for properties that are the same or greater than what my client was selling.
Got it. I know we're getting close to the end. I only have just a couple more questions. And if we don't get to any questions that you have already asked, I think Chris already identified his email. I bet he will be happy to answer any additional questions you guys have. But just to wrap it up, there's one that says capital gain deferment at a later point in time. What is that point in time? And when you sell the property you invested that money in?
Okay, so here's the cool thing. So what happens when you're doing a tax deferral on real estate is the tax basis is going from property to property to property. So if you sold something in 1980 and you kicked the tax can down the road, and then you sold it again in 86, and then you sold it in 93, and then you sold it in 2023, you can keep kicking that tax can down the road. Now the basis is carrying forward. So if at any point you cash out, then it's going to relate all the way back to that original 1980 tax basis sale, okay? Minus depreciation plus improvements that you've made to the properties over the years, okay? But here's the thing. You can keep doing these deferrals again and again and again and keep expanding your real estate portfolio over time. So there's no limit on the number of 1031s that you guys can do. The other thing is, and this is where I take off my 1031 hat and pull on my attorney hat. You notice that my attorney practice is really focused on estate planning. And one of the things that is under current tax law is that when someone dies, they get what's called a step up in tax basis. And so what that means is that usually when we gift somebody property, we gift them the property and we gift them whatever our tax basis was, okay? So if we give somebody property the day before we die, they sell it the day after we die, they're going to pay taxes based on the tax basis that they got from us. When somebody passes away, the tax basis for the property increases to their date of death value, okay? So if you've done all these 1031 exchanges in the past, all the way back for 30 years, okay, and then your client passes away, all of that deferred tax goes away. And when the kids inherit it, or when the spouse inherits it, or whoever inherits it, the new tax basis in the properties is going to be the date of death value. So this is one of the very, very few ways where you can kick that tax count down the road. And then at the point that you pass away, those taxes go away completely. They're not even deferred anymore. They're just gone because of the step up in tax basis. So your clients really can utilize this. Now, obviously that's not going to work in a setting where there's an LLC or a trust or something like that, because you're not going to get the step up in tax basis typically. But if it's held in the individual's names, you can push that stuff forward. One of the things that you can do that is kind of cool, nobody asked this question, but I'm just going to volunteer it because I know you guys are commercial practitioners, so this is going to come up. We do have a lot of people that will call us and they say, hey, we're in this LLC and we've got 3 partners in the LLC. I want to take my money from this transaction. I want to go do my own thing. Okay. My partner wants to just cash out, and my third partner wants to take his money and go do his own thing that doesn't involve me. Okay. So there's a type of 1031 exchange, which I would love to spend more time talking about at some future point in time, called a drop and swap. where we take that property and we drop it out of the LLC into the individual's names so that then each individual can go do whatever they want. So I can do it and invest. Like we had a client last year who sold an office building in Huntsville, Texas. And one of the partners bought condos in Florida. One of them bought real estate interest in Delaware statutory trust. And the other one went on a cruise and spent money like it was going crazy at a casino. So, you know, there is the possibility of kind of moving some of these pieces around to get what you want. So anyway, little hint, drop and swap. If you have any questions, just let us know.
Which we really appreciate that. I recognize that we are after 1 o'clock. The one last question and request is, can you please make sure you put your contact information back up there so they can get a chance to get in contact with you should they have any follow-up questions or what have you. So if you could
Sure. Let me share it right now.
Awesome.
So we're super easy to get a hold of. Brazos1031exchange.com, soon to be wealthbuilder1031.com. And then our phone number and toll-free number, both of which are going to stay the same. So those won't change at all. And then if you need to get a hold of me directly, it's just Chris, CHRIS at Brazos1031exchange.com.
Awesome. Mr. do you have any closing remarks?
Thank you. That was incredible. Thank you so much. And as you can see from the response from nearly 170 people, there was a lot of interest in what you presented today. So we appreciate your time and your expertise.
Yeah, thanks for having us. We appreciate it.
On behalf of all of us and Chris, yeah, again, thank you so much. We really appreciate your time. And thank you guys all for participating. Y'all have a great day.
Thanks, guys.
Bye, everyone.